Hello friends, welcome to Nirmal. I'm Piyush Jain, and today we are going to do a conversation around the economy. We have seen again how the markets actually have been performing after the budget was delivered, and after that, a couple of economic indicators have come up. We have seen the recent GDP data, which came for the third quarter. There has been announcement regarding fiscal deficit numbers. Other sector growth numbers have also come up from the perspective of great growth numbers, different auto sales numbers, and it's very important to really understand how the underlying momentum is looking. And as we move into the fourth quarter and then FY24, how's the broader overall growth environment looking like? Why it's so important? Because these growth numbers, they also actually feed into creation of a demand environment for the listed companies, and thereby actually are able to relate that to the earnings growth environment also. So to understand this technicality, let me now welcome our expert on the economy, Ms.Aditi Nayar, Chief Economist of ICRA Limited. Aditi, as always, welcome to the show.
Thank you.
Now, Aditi, let's first start here from the perspective of what's happening on the GDP. The recent third quarter GDP growth numbers, they came about, and looks like some softening has continued. Within the print, there were a lot of numbers. Some sectors were showing very strong growth numbers. Overall, GDP growth is slowing down. Government expenditure is slowing down. Private expenditure is slightly slowing down. Gross capital formation is increasing. So for an average viewer like me, perhaps what the real confusion is it looking a sort of good rosier picture as we move ahead, or we actually are seeing a slowdown in the domestic economy mirroring the global economy?
Thanks, Piyush, and it's a pleasure to be here. You know, the GDP numbers that we got a couple of days back have really provided a lot of data as well as a lot of confusion, I feel, has been created, partly because we got revisions in the numbers for the last couple of years, which are being accused of actually dampening the YOY growth for the quarter for which we got the most recent numbers. So that's one part of the puzzle that we have. If you look at the YOY growth, it has slowed down from Q2 to Q3, which is what we expected. But the actual level of GDP growth in Q3 has come in well below what we had expected at ICRA. And what we are most surprised by is the very low growth that is getting indicated for consumption, both private and government. Private specifically because we've seen a period where the recovery in services consumption has been very, very high. So that's difficult for me to really correlate with the overall private consumption data that we got from the government. So I do suspect that we are going to get maybe an upward revision in a couple of segments going ahead when the revised data comes in line with the upward revision that we've seen in many of the underlying sub-indices for the last couple of years that we got on the 28th as well. The second thing that we would like to point out is that if we take the full year number that the NSO has estimated, which is still 7%, and we look at the revised number for Q1, the unchanged number for Q2, and the new number for Q3, what we're actually getting for Q4 is a growth which is higher than the number for Q3, which they've just put out. So does that mean that actually Q3 was the bottom and they're going to look up going ahead? That's, another sort of trend which is baked into the data. The third thing is that looking at a YOY comparison is really maybe not the best thing to do because we have a lot of base effects in the last couple of years because of the COVID waves coming in and out. So if we actually compare Q2 and Q3 to the respective pre-COVID quarters, then the growth momentum has improved in Q3 as compared to Q2, and partly because of services, which is what I was just talking about. So, that's the dilemma. Do we look at these numbers as being weaker than anticipated? Or do we look at these numbers as actually showing that the underlying growth momentum has improved when we compare it back to the pre-COVID levels? So I'm going to say that the glass is half full. And I'm hopeful that what I see as a strong consumption recovery, particularly for services, is something that's going to continue going ahead. There's a lot of money on the table as far as CapEx is concerned from Government of India, from the union budget that we got last month. And I am hopeful that we're going to be able to get, if the CapEx spending kickstarts early in FY24, then it has the potential to create a very good multiplier through the year to really push infrastructure growth as well. Exports are unlikely to do well next year given the global slowdown. So that's something that we just going to have to live with for the time being.
Right, and Aditi, there's so many components to talk about. So I'll just pick one component first here. Great growth was looking sort of a good number. Uh, in your sense, what is driving this great growth?
Lots of things. Actually, credit growth, we're coming off a very low growth in the previous year. So there's a base effect. We have working capital requirements going up very sharply through H1 with the rise in commodity prices. That's another factor. Then we've had the rate transmission being much faster to the bond market than to the bank loan markets, particularly in the first half of this fiscal year. And so there's been a lot of shift in demand to the bank credit side from the bond market side. Similarly, we've seen a refinancing of ECBs happening through local bank credit, and that's another shift that's happened as well. All of these factors may not sustain going ahead, so we expect that the YOY growth in credit is probably going to come off next year. But on an absolute basis, also the numbers should remain reasonably good, but certainly the YOY growth is something that we expect will moderate going ahead.
Right, and when you actually relate that to sort of growth from the perspective of auto numbers, or actually when you see from the perspective of logistics, that actually has grown a lot. Is there any feeling that domestically the trade activity remains quite robust, or within those numbers, is there anything which where you can tell us that there is some inherent slowdown?
So there is unevenness. Auto sector is a very good example of the unevenness that we're seeing in the ability to consume across different income levels. So for passenger vehicles, where there was a chip constraint, and now those issues have eased out, we're seeing very high growth numbers coming in FY23. And it's interesting because this is a segment where the inherent ability to purchase or the affordability was probably very good before the pandemic also. But there were behavioral choices that people, younger millennials, younger people in the workforce were choosing to Uber instead of buying a car. And the pandemic has changed all that. So there was a lot of, I'm not going to just call it pent up demand because pent up demand means that something was choking it. But there's a behavioral change as well, which has come about after the pandemic. That younger, millennials who could buy a car were choosing not to do it are now choosing to do it. So that's really pushed growth in segments like PV, despite price hikes and despite fuel prices being very high. But on the other hand, if we look at the two-wheeler market, things are much, much more subdued over there because the price increases for that segment, which is much more cost conscious, as well as the fact that fuel prices are very high, make it a much more difficult decision for a family to go in to purchase a two-wheeler. And we're seeing that demand is lagging in that category, and it may take a few more quarters for things to sort of get back on track.
Right, and let me take a step back and also ask on agriculture, and I'll come back to the sector again. On agriculture, we know the Rabi season, basically, we're in the middle of it, and some weeks later, again, we'll start talking about the harvesting. But what's your opinion on the acreage? How's the Rabi season looking to you, and what impact are you foreseeing as we move towards the next couple of months?
So, we had good reservoir levels and the Rabi sowing started early. And that's why we've seen acreage actually exceeding our expectations. And the first fertilizer availability was also not such an issue in the Rabi season. So we've got the first, rather the second advanced estimates for the Rabi crop, which are quite good. And we're seeing many subcrops where the NSO is expecting record harvest as well. Now, all of this is good news, but we've still got the month of March to get through, and temperatures in this month are going to play a fairly crucial role as far as the eventual yields are concerned. So I'm not going to say that we're out of the wood. Certainly, the data we have so far is very good, but this is a very critical month to make sure that we actually end up with a good harvest. And what level of temperatures we have is going to guide that. And of course, from next month, we're going to be in monsoon watch. And let's see, at least reservoir levels look reasonable at this point in time, so that in case there is a late onset to monsoon, we have some insurance coming in from the reservoir levels. So, but that's, complete wait and watch at this point in time.
I would actually also link this to what the government actually announced in the budget also. A lot of spending in every sort of capex, agri infra. When you look at this data and a sort of reasonable expectation in terms of agri growth, And when you look at that from the perspective of a broader economy, agriculture, fishery, the sort of the plain vanilla agriculture we talk about, all of this holistically, whether it's forestry or everything. What's the sense of FY24? Like how are the next 12 months looking to you?
See, for the agricultural sector, I think these two factors that we just spoke about, how the temperatures are this month, and then how the monsoon kicks off, what impact, whether an El Nino fully develops and what impact that has on the monsoon, are really going to drive where we end up on agricultural output going ahead. My baseline expectation every year is that we will end up with a moderate growth. That's what we built into our numbers at this point in time. But I think the risks are unfortunately more to the downside. I see limited upsides going ahead. As I said, reservoirs give us insurance, but the possibility of a downside is significant. But we'll have to wait and watch. If we end up with a bad monsoon, it could possibly shave off 50, at worst, I would say 50 basis points from the 6% GDP growth that we're estimating for FY24. So 6% is our baseline, and a bad monsoon, bad agri could bring that down to 550. That's the rough numbers that we're working with right now, but it's a completely evolving situation, so we have to wait and watch and see how this develops.
Right. And what's the broader sense you have right now on the rural consumption strength at present? How are you sort of looking at the sort of broader metrics?
See, rural is a micro market. The macros may not really paint a very representative picture of too many parts of the rural economy. So that's something that we have to live with. And again, within rural, if you look at tractor numbers, those are very good. We recently revised up our tractor volume forecast for FY23. And that's because the tractor sales have been very good this year, even on a high base. And so that part of the market seems to be doing okay. But again, if we come back and look at motorcycles, clearly there is an unevenness, even within the macro data for the rural sector, and I'm sure every state would be performing quite differently. So I would say that there is unevenness over there as well. Possibly a lot of people have shifted back to their erstwhile urban sector jobs, and that is depressing some of the rural consumption numbers because simply people have moved back. And because they moved back, remittances should have restarted, which would actually be supporting the rural economy. So I would say that possibly sentiment remains quite mixed, but there would be parts of the rural economy that is represented by the tractor segment, for example, that are doing better. But overall, clearly there is a lot of unevenness over there as well.
Okay, and that's the sort of rural one. Let's also sort of talk about from the perspective of imports. What is your reading into the imports? We have seen some slowdown, like no surprise, like one would have expected. It would have been a surprise if the imports actually would have continued at a scorching pace. What's your reading there?
See, broadly now we're in a phase where we are seeing a leveling off, and not a leveling off. What I should say is that commodity prices have come down from the peak and are now similar to the year ago levels. Next quarter, a lot of commodity prices will be lower than the year ago levels. So this is something that is going to bring down imports and exports. And if we specifically look at the January imports, there was a fall in the volume of crude oil that we imported. And we had felt for the last few months before that crude oil volumes looked a bit higher than needed. So this is some sort of a readjustment, and gold imports were very, very low. So all of these factors put together brought down the merchandise imports quite a bit. I'm not sure that the level of trade deficit we got for January is necessarily sustainable going ahead. So we may get a slightly higher trade deficit number on average over the next 6 odd months. But one more sort of palliative is that services exports are continuing to do very, very well, and that's helping to push up the services surplus number, which will absorb some of the pain on the merchandise export side. Overall, for the current year, we are looking at a current account deficit of about 2.8 to 2.9% of GDP. And this is quite a relief compared to the fears that were there around July, August, that we were probably going to be close to a 3.5% of GDP kind of number. So, Certainly, in the last few months, the pullback in the trade deficits has helped to reduce the anxiety on the current account deficit. We think Q2 was a peak, and Q3 and Q4 are going to be significantly lower than the all-time high we got in Q2. For FY24, because the global economy is still looking quite dull, and we're not sure if the pace of services exports can sustain, we're building on a little bit of a deterioration. But I would not expect the current account deficit to exceed 3.2% of GDP in FY24. So this is high, but it's manageable. It's not an alarming level.
Right. And before we shift to the bond market, let me ask you one thing. Tax collections, any major observation so far? How are they looking to you? Both indirect taxes and the sort of normal other part of it?
So as compared to the revised estimates, I would say that we think that there may be minor deviations. Maybe on the direct tax side, the implicit growth left for February, March looks a bit high compared to what we've seen in the previous few months. But other than that, I would say that for tax collections for FY23, mostly we should be on the target of the revised estimate. And then for FY24 as well, there could be a very mild downside as compared to what the government has budgeted. Overall, we're not terribly concerned that there will be an underperformance on the tax revenue side.
So, what is sort of tax collection growth estimate you are sort of budgeting right now in your estimates for FY24?
We had projected 9.8%, and what the government of India has budgeted is a little higher than that. It's closer to 10.5%. So, like I said, it's just decimal. It's really not so much of a deviation between what we have projected and what the government has budgeted. So, at best, at this point, I would expect that the undershoot could be about 50,000 crore. So, not really a material fiscal concern.
So, Aditi, then I actually want to borrow your mind because everybody was saying government is looking conservative in the budget estimate. And when I see your estimate, I have to ask you, who is more conservative? Is Aditi more conservative or the government actually is conservative?
See, for next year, we had written a nominal GDP growth of 10%. And at the time of the budget, what the government had indicated was 10.5%. And I think with the latest GDP number that we have for FY23, it's a little bit higher now at 10.9%. There's a couple of reasons. Like customs duty is probably not going to do very well in a situation growth, global trade volumes are low. So we, think that customs duty is looking slightly optimistic. Similarly, on the excise side, we do feel that, we know that there's going to be 2 more months of an overhang on the excise duty collections from the May 26, 2023 to cut in the excise duty rates on petrol and diesel. So that's going to create a continued contraction for 2 more months. So, a couple of specific things like this. Rest, direct taxes and GST, I think, will broadly be in line with what the government has budgeted. So, as I said, it's just a minor deviation. We think that there could be a slight undershooting from what the government has budgeted, but not very much. So, maybe at this point, I'm open to it, but that's our view.
So I think it's prudent and safer actually to follow the estimates. In the best scenario, you can only get a positive surprise from the government from that perspective. So Aditi, let's actually go to the bond market here. Because of interest rate hikes, we have been actually seeing upward pressure both in the short-term side and the long-term tenor side. What has been your observation so far? Firstly, let's talk about on the government 10-year securities. What has been your observation?
So I would have thought that the 10-year yield would be higher than what it is right now, given the fact that the market is now convinced that there will be another rate hike in April. It's not fiscal in any case that is the driving trend would be behind the 10-year bond yield right now. It's more a monetary tightening that is anticipated. And the last February policy review, a lot of people expected a change in stance, which didn't come through. The window was clearly left open for more rate tightening, and then we got that horrible CPI inflation print for January. Our estimate is that we're not going to get much relief in the February print either. And the optics of 2 CPI prints which are above 6% make another rate hike seem very likely at this point in time. Fed still remains very aggressive as well. So in this situation, I would have thought that actually bond yield would have been a little bit higher. So we are penciling in 735 to 755 kind of a range for the rest of this month, basically until the next policy day. And then, of course, what the MPC indicates going ahead will then determine where a rate sort of settle in Q1.
Right, and I was also reading through your report where you were actually saying that the spreads between the state government bonds and the 10-year SECs, those actually have reduced. And this is a sort of a coherent observation. You have just highlighted the 10-year securities that they are trading at a sort of a lower yield where you would have expected. And same again, the spreads are also getting compressed. What is the bond market telling us? Is it telling us that there is a lot of demand, and that's why basically the yields actually are staying lower when they should have been? Or is it something where the bond market participants are expecting that maybe the sort of rate hike cycle is over, or another rate hike, and then after that perhaps there's nothing going to happen? Like, what are your thoughts on it?
See, for the most part, if you add Government of India and the state governments together, supply has been lower than what has been indicated through FY23. So we've seen for the first 3 quarters that the state governments have announced a larger borrowing program and then under borrowed. And the same thing has happened up till Q4 as well, except I think the next option, which is after a long time, state governments are actually, they notified an amount which is higher than what they had indicated. So it's not about demand. I think it's that supply has trailed what the market was expecting based on what the state governments themselves were saying. So that is something that has helped to keep the spreads compressed as well. And traditionally, we've seen state government 10-year spread over GSEC being 60 to 80 basis points in normal times and going up to 100 basis points in Q4. That used to be very normal because in Q4, states borrow a lot normally, and the Government of India's borrowing stops by mid or late February. So 100 basis points was not unheard of at all in Q4. And we've seen most of FY23 at 30 to 40, 45 basis points maximum. So it's certainly been a very odd year. And part of this is because the states have over indicated and underborrowed.
Okay, so that's something that just played in their favor. But from there, how's the sort of short-term market looking to you so far?
See, short-term market is going to remain very, very sensitive to what is expected from the MPC. So I think that the commentary of the next MPC meeting is really going to guide where we go on the short-term rates. But I would expect them to remain on the higher side.
Right. How's the sort of Sure. How's the sort of interbank liquidity looking to you? There was a time many sort of months back or a couple of quarters back where we're talking about like a huge sort of surplus liquidity, which has gradually decreased now. So how is that looking to you?
I think we're going to remain, in a very small surplus to deficit for the most part going ahead. And if we get into a situation where the systemic liquidity seems to be turning into a more steady deficit, then we're not ruling out a reversal of the CRR hike that had taken place in FY23. And that's not the first thing that we expect the RBI to do. We do think that, VRRs, VRRs, those will be the go-to as far as liquidity management is concerned. But before going in for OMOs, it's likely that the CRR hike might be reversed.
Okay. And in this sort of Q4 and perhaps a bit of Q1, do you expect the RBI to be more accommodative given the sort of uncertainty we are seeing in the global markets? From the perspective of liquidity, I'm asking only from the perspective of liquidity.
Well, I mean, they've said that they will provide liquidity on a two-way basis. So, in that sense, yes. I mean, we do think that the variable rate auctions will be forthcoming as required, especially as we get toward the end of March when liquidity typically does tend to tighten.
Okay, let's go to the headline GDP growth numbers. You've already talked about it. You've also actually sort of given us a sort of a possible downside with respect to conditions here. From the perspective of budget, we have seen a sort of all-time high capex being announced by the government, and I'm going slightly to the gross fixed capital formation here. Is it too optimistic right now to really sort of expect a major upliftment in the gross fixed capital formation? And is there a sort of possibility that towards the second half of the next year we could see a much more stronger growth? How we should read into that?
So government capex, is a little higher than what we had penciled in, but I think a lot of it seems the target seems fairly credible. The only concern I have is whether the states are going to be able to pick up the upwardly revised amount which they have for FY24 in terms of the state capex loan scheme. So we saw that there was a huge increase in allocation to 1 lakh crore in FY23 at the time of the budget. Offtake was quite tardy. That's been reduced to 73 or 76,000 crore. And now for next year, the target has been increased to 1.3 lakh crore. So can the states take this extra money that is being put on the table? I think that is the biggest concern we have on the capex side. And how quickly the capex money starts rolling out has a, influences the multiplier effect on GDP growth through the other quarters of the year. The earlier capex is spent, the larger that we feel that the multiplier it can create going ahead. So an early start is something that is very important. That could lead to an upward revision in the subsequent quarters GDP growth. So that is the biggest upside that we're hoping will turn out.
Okay, and let's round up the entire discussion. And if I want to ask you a sort of a very simple comment, as per all the data so far till February, and we have stepped into the March, are we actually looking for a good closing for FY23?
See, for FY23, for Q4, we are estimating GDP growth between 4.5% and 5%. If the first 3 quarters data is not revised further from what we got on 28th of February, then that means that GDP growth for the full year will be 6.8 to 6.9%. Now, I held on to a GDP forecast to 7.2% for FY23 up till Feb 28 because I did think the Q3 numbers were going to turn out to be much better than what we got from the NSO. So if there is an upward revision, we may still be above 7%. And I do think that that's the direction in which revised data will end up taking us. But at the face of it, given the data that we have so far, Q4 takes us to 6.8 to 6.9%. And baseline, we expect 6% in FY24. Quick kickoff of government capex can push that number up materially, and band monsoon can take us down by maybe 50 basis points.
Well, Aditi, as always, exhaustive take on the economy. Thanks a lot for giving all the data and your views to our viewers.
Thanks, viewers.
And with that, viewers, it's a wrap on this show. Hope you enjoyed it.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.